everyone. Let's start another topic, small and important and easy topic. The name is pension income pension plan. And after this topic, inshallah, we'll go for employment income. But let us first discuss pension. Actually, in our syllabus, we have two registered pension scheme. One is occupational pension plan, another is personal pension plan. For occupational pension plan, let me discuss few things. You will only be getting occupational pension plan, number one, when you have a job, and the second is your employer is running this pension plan. Okay, if being an employee you contribute in occupational pension plan, it is treated as an expense for you. Employees contribution in occupational pension plan reduces the employment income. Second, if employer is contributing for the employee in occupational pension plan, then it is an exempt benefit for employee. Third, for employer, contribution in OPPC for employee is an allowable expense. An employer will deduct contribution in OPPC for employee as his expense from his trading profit. In addition to that, if employer is contributing in personal pension plan for employee, then it is an exempt benefit for the employee but an allowable expenditure for the employer. An employer is going to deduct that contribution from his trading profit. And when it comes to personal pension plan, when individual is contributing for himself, we have already discussed whatever you contribute in personal pension plan for yourself, it is not your expense. Whatever you contribute for yourself in PPC, it is taken as 80%. 20% will be paid by HMRC, and basic as well as higher rate band will increase by gross PPC amount. And third, we have already discussed adjusted net income reduces by gross PPC. So occupational pension plan which is maintained by the employer. If employer makes contribution, then it is exempt benefit for employee. When employee makes contribution, then it will be allowed expense, for example, which will be deducted from his or her employment income. When employer makes contribution, it will be allowed expense for employer, which will reduce trading profit. PPC, pension plan maintained by the private bodies, for example, insurance companies, could be bank. If individual makes contribution, 20% contributed by HMRC, basic and high rate band will increase by gross amount, adjusted net income reduces, because whoever is having adjusted net income more than 1 lakh, we know that personal allowance starts reducing. And anyone who is having adjusted net income more than equal to 1,25,140, that individual gets personal allowance 0. Okay. If employer contributes in OPPC for employee, it is an exempt benefit. Okay, now let's move ahead. Let us discuss one more concept. What is that? Okay. Now another concept which we are discussing is, what is the limit of contribution in pension plans? How much an individual can contribute in pension plan? The answer to this is you can contribute as much as you want. But according to HMRC, annual allowance for pension is 40,000 pound. According to HMRC, annual allowance limit for pension is 40,000. Now there are two questions. Question number one, if someone contributes less than 40,000 pound, then what we need to do with the unused limit? Second question, if someone contributes more than 40,000, so what are we going to do with the excess contribution than 40,000? Two relevant questions, of course. Number one, if someone contributes less than 40,000, then unused limit of annual allowance is carried forward for 3 tax years, and it will be used on FIFO basis. Let me repeat. If someone is contributing less than 40,000 pound, then unused annual allowance limit is carried forward. It will be used. It will be carried forward for 3 tax years, which will be used on FIFO basis. Which means that, let's say, I have Mr. X, let's say, who is a member of registered pension scheme, and in our syllabus we have only two registered pension scheme. One is occupational pension plan and another is personal pension plan. Let's say Mr. X became the member of registered pension scheme in the tax year 15-16. Okay, let's say your examiner says in 1920, 2021, and let's say 1890. In 1819, in 1920, 21, assuming gross PPC which Mr. X contributed. In 1819, the contribution was 20,000. In 1920, the contribution was 10,000. In 2021, the contribution was 15,000. Which means, if I ask you what is the unused annual allowance? Unused annual allowance. So from 40, you need to deduct 20. We have unused 20,000. From 40, I need to deduct 10. So unused is 30,000. From 40, I need to deduct 15. So I have unused 25,000. Okay. Let's say the current tax year is 21-22. In current tax year, (21-22), Mr. X wants to contribute 50,000 gross PPC. That's great. In current tax year, which is 21-22, Mr. X wants to contribute gross PPC 50,000. Okay. Required. Calculate unused annual allowance carry forward in 21-22. You are required to calculate unused annual allowance limit to be carried forward in 21-22. Of course, whatever I am going to carry forward in 21-22, it will be brought forward for 22-23. Carried forward of 21-22 is going to be brought forward of 22-23. Okay. Now let's try to solve this question. Number one, Dear student, whenever you are solving this pension question, first you have to utilize current year annual allowance limit. After that, if you still have contribution which is more than 40, if you still have contribution after using current year annual allowance limit of 40,000, if you still have contribution, then you have to go back 3 years from your current tax year and utilize your gross PPC, your pension contribution from unused limits. What I want to say, let me explain this through my answer. Tax years, gross PPC, unused. Number one is 21-22. We have the limit of 40,000 minus 40. I do not have any unused limit. And remember, in current tax year 21-22, I have contributed 50, not 40. So still 10,000 is left. From the current tax year, I have to go 3 years back and I will be using previous unused annual allowance limit on FIFO basis. So from 21-22, if I go 3 years back, so it's going to be 20, 21, 19, 20, and 18, 19. Okay. Since we'll be using previous unused limit on FIFO basis, so I'm writing 18, 19, 19, 20, 20, 21. Now listen and listen carefully. In 1819, unused limit was 20. In 1819, we had unused limit 20,000. Okay. From this 20, I will deduct 10,000. Why 10? In current tax year, you have contributed gross 50. First, this contribution will be deducted from the current year limit of 40,000. After that, I will go 3 years back. And in previous 3 years, I need to go 3 years back. And then I will use unused limit of previous 3 tax years on FIFO basis. So in 1819, I had unused limit of 20,000. So from that 20, I'm going to deduct 10. So I will be left with this. 1920, unused limit is 30. I'm not using any limit from this 1920. So 30 will remain 30 unused. And in 2021, I have 25. So still I have unused limit 10, 30 and 25. But my examiner has asked me what will be the unused annual allowance carry forward for 21-22. Now listen and listen carefully. We need to calculate carry forward annual allowance. So carry forward an annual allowance unused limit. Carry forward annual allowance in 21-22. You got to understand one thing. Carry forward of 21-22 is going to be brought forward of 22-23. And the rule says unused annual allowance can only be carried forward for 3 tax years. And it will be used on FIFO basis. Now listen and listen carefully. I can maximum carry forward 3 years unused limit. Okay, and that will be used on FIFO basis. 3 years. Now I need to calculate carry forward. Listen, but I'm going to calculate carry forward unused limit. So now this 18, 19, 10,000 will not come. Why? Because I can carry forward maximum 3 years unused limit on FIFO basis. Maximum 3 years. Maximum 3 years means I can carry forward unused limit of 21, 22. That's going to be 1 year. I can carry forward unused limit of 2021. I can carry forward unused limit of 1920. So that's going to be 1, 2, and 3. So simply, I cannot carry forward any more unused limit of 1819 because unused limit of 1819 can be obviously brought forward for 2122, but it cannot come in carry forward of 2122 because I can maximum carry forward unused limit of 3 tax years. So in 2122, even though I don't have unused limit, but this tax year is countable. So there is going to be 19, 20, 20, 21, and 21, 22. So unused which I can carry forward as 55,000. Unused annual allowance which we can carry forward is 55,000. So I believe now you should be having a good idea of this unused limit which we need to carry forward. Let me give you another example. Let's say tax years 18, 19, 19, 20, 20, 21. We have gross PPC 25, 40, 45. Okay, let me change this. Okay, we have gross PPC. Okay, in current tax year, 21, 22, gross PPC is 20,000. In current tax year, 21, 22, gross PPC is 20,000 required. Calculate annual allowance unused carry forward in 21, 22. Obviously, the unused limit which I'm going to carry forward in 21, 22 is going to be brought forward for 22, 23. Okay. How to solve the question? As I mentioned earlier, first you have to use the current year limit, and after that, if your contribution is more than 40,000, then you go 3 years back and use the unused limit on FIFO basis. Okay, let's see this. Unused annual allowance. We have the limit of 40,000 and previously he has contributed 25, which means unused is 15,000. 40, the contribution was 30, so unused is 10,000. 40, the contribution was 45. I'll deduct 40. I'm going to get 0. So actually in 2021, contribution was 45. Okay. And this is the only information which we have in the question. out of this 45, first 40 will be used in the current tax year 2021. So still 5,000 is left. So logically, the remaining 5,000 we need to go 3 years back, and remaining 5,000 will be deducted from unused limit of the previous 3 tax years on FIFO basis. But we do not have any information of 1718. If we had any information of unused amount of 1718, then remaining 5,000 I would have deducted from that unused limit. Since I do not have any information of 1718, so what I'm going to do, remaining 5,000 out of this 45 I'll deduct from here. So I'll come to 10,000. Okay, now in the current tax year 21-22, what is happening is contributing just 20. So let me write this here. 21-22, it is only 20. 40 minus 20 gives me unused 20. Now we need to calculate how much annual allowance we can carry forward. As I mentioned earlier also, only unused limit of annual allowance can be carried forward for 3 tax years on FIFO basis. So now the current year is 21-22, we can maximum carry forward 3 years tax, 3 years unused limit on FIFO basis. So that's going to be 19-20, 20-21 and 21-22. Because carry forward of 21-22 is going to be brought forward of 22-23. So unused limit of only 3 years can be carried forward, and these 3 years are 19, 20, 20, 21 and 21, 22. So the amount is this amount simply we cannot further carry forward because it is not coming in 3 tax years. So these are the 3 tax years. So we can maximum carry forward 30,000, 10 and this 20. So now you should be having a really good idea about this unused limit, how to use that. So simply, if you have any unused limit out of this 40,000, so unused limit will be carried forward for 3 tax years on and it will be used on FIFO basis. Okay, now another question is, how do we use basically this how do we use this 40,000 annual allowance limit? What I want to say, how it gets consumed, this 40,000 limits. Actually, annual allowance $40,000 limit, it consumes due to maximum 4 contributions. What are those 4 contributions? Look at this. It's here. Annual allowance limit will be used if employer is contributing in OPPC for you, occupational pension plan, if employee is contributing in OPPC, employer contribution in PPC, individual gross contribution in PPC. So from this 40,000 we have to deduct all these 4 contributions if we have in the question. If the amount is positive, then we need to carry forward for 3 tax years and use on FIFO basis. If the amount is negative, it is also possible that you have contributed more than the limit. That represents excess pension contribution. It is excess contribution is treated as your non-saving income. If excess contribution is made, then it considered as non-saving income and it will be taxed at the end. So if you have contributed more than the 40,000 and you do not have any previous unused limit, then on excess, the excess contribution will be treated as your non-saving income and you need to pay tax. Let us apply this concept on this question so that you should be having a clear idea what actually I want to say. Mr. N is having an employment income of 96,000. Okay. Following contribution were made in pension plan. Employee contribution in occupational pension plan 35,000. Employee has contributed 35,000. If employee contributes in occupational pension plan, it is treated as an expense of that employee. So from 96 we need to deduct this 35. Employer contribution in occupational pension plan is 15,000. Whatever employer contributes for employee is an exempt benefit for the employee. Mr. N contributed in personal pension plan is 12,000 net, gross is 15,000, and has no unused annual allowance. Previously, he does not have any unused annual allowance, which means that only in the current year 40,000 is available. So let's solve this question 14. Let's take this. Employment income is 96,000. Let us deduct employees contribution in OPPC. Occupational pension plan contribution, it was I believe 35,000. When employee contributes in occupational pension plan, then this contribution is an expense for the employee. When employer contributes for employee, it is an exempt benefit. Employer's contribution, that is exempt benefit. So I'm not supposed to do anything. Mr. N has also contributed in PPC. If individual contributes in PPC for himself, it is not an expense of that individual. So from this 96,000, we need to deduct this 35. We are getting 61,000. We're getting 61,000. That is net employment income. Let us deduct personal allowance 12570. We will have taxable income 48,430. Okay. Let's calculate income tax. So before calculating income tax, we need to check uh, what is the limit of basic rate band, because this individual has contributed in PPC as well. So basic rate band limit is 37,700. We need to add the gross PPC. Net is 12,100 upon 80, that becomes 15. So which means that basic rate band limit is now 52,700. Basic rate band limit is 52,700. We have taxable income of only 48,430. So obviously the entire income falls in basic rate band. I have to take 20% of this. 48,430, 20%, 48,430, 20% of this. 9,686. Now listen and listen carefully. Now we need to check total contribution of employee as well as employer. If it is more than 40,000, then on excess contribution, Mr. N will have to pay tax. So let's try working one. Annual allowance limit is only 40,000 and previously he does not have any unused limit. Let's deduct all contributions. Employees contribution in occupational pension plan, which is 35,000. Employers contribution in OPP, how much employer has contributed? 15,000. So we need to deduct this 15 as well. And we said an employee's contribution in PPC, employee's gross contribution in PPC, employees gross PPC contribution, which is 15 as well. So here comes the excess contribution, and excess contribution is called annual allowance charge. Okay, let's see. 25,000 negative is representing excess contribution. We call this annual allowance charge. This annual allowance charge is subject to tax and applicable tax rates are of non-saving income. Now come here. Where is okay this basic rate band limit is 52,700. Out of this 52,700 we have used the limit 48,430, which means that unused basic rate band limit is how much? 52,700 minus 48430, it gives me 4270. Actually, I have to calculate income tax on annual allowance charge, which is 25,000. But out of that 25, 4270 actually falls in basic rate band because we do have a limit of 4270 in basic rate band. And all of the amount over and above 4270 falls in high rate band. So let's calculate tax on annual allowance charge. Annual allowance charge, working one. Let me clarify this working one. Working one. 4270 into 20%. It is 854. Annual allowance charge. Annual So from 25,000 you have to deduct 4270. 25,000 minus 4270, the remaining amount is 20,730. Now I have to use higher rate band because basic rate band is finished. 8292. Let me check. 9686 plus 854 plus 8292. So that's great. Income tax liability is 18832. This is your income tax liability. So simply income tax liability is 18,832. That is simply great. Okay. Now let us discuss one more concept. What is that concept? Actually, this concept is very important. Every concept is important, but this is very important, which we are discussing right now. What is that? Actually, there's a rule relating to gross PPC. Actually, basic rate band and high rate band will increase exactly with what amount? There's a rule for that also. Before this, whenever we saw gross PPC, what we did? We just increase our basic as well as high rate band with that gross PPC amount without even thinking for a second. But now we are discussing a rule. The rule says pension relief restriction. Band is extended by lower of. Number one is your gross PPC, whatever you have contributed, gross PPC, and the second is higher off. When it comes to higher off, it is higher off 3600. It is a fixed amount. And another point is total of relevant earnings. There are three relevant earnings: one, two, three. Employment income, trading income, and income from furnished holiday letting. If you try to recall, when we were discussing furnished holiday letting, so in advantages of furnished holiday letting, there was one advantage relating to, and it was written in one of the advantages of furnished holiday letting was that income from furnished holiday letting is a relevant earning for pension. So it is coming here right now. Total of relevant earnings is employment income, trading income, furnished holiday letting. For example, the gross PPC is 40. I'm just assuming. Okay, let's take gross PPC is 30,000, and total of the relevant earning is, let's say, 70. So when I say higher of 3600 and 70,000, you will take 70. When I say take lower of gross PPC and 70,000, so you will go for gross PPC 30,000. It means your basic and high rate band will increase by 30,000. What if gross PPC was 130? If your gross PPC was 130 and relevant earning was 70, so your basic and high rate band would have increased by 70,000. So when do we need to check band extended by? The hint is whenever you have a PPC given in the question, you need to check that band will exactly increase with what amount. Let's try question 15. Mrs. Z has property income 37,000, trading income 7,000. He made pension contribution 12,000. A very important point. Nothing is mentioned. Then whatever contribution is made in PPC, it is always treated as net. You have to gross it up by multiplying 100 and divide that with 80. He made a pension contribution 12,000 in personal pension plan. He has unused annual allowance previously 26,000. Compute tax payable. Okay. Property income is a non-saving income. Trading income is a non-saving income. Property income is a non-saving income, no doubt about it. Trading income is also a non-saving income. Okay. Let's try here. Non-saving. Property income 37,000. Trading income 7. It becomes 44. From this 44, you have to deduct personal allowance 12,570. You will get taxable income. 44,000 minus 12570, it is 31,430. Obviously, entire 41,430 falls in basic rate band. 31,430 into 20% results in 6,286. So the amount of the tax is 6,286. Now let us check, just for our sake of our understanding, that band will actually increase with what amount? Okay. The rule says band will increase with lower of hmm, band will increase with lower of gross PPC. Gross PPC in this question is 12,000 is net. If I make it gross, it becomes 15. Okay. Higher off then. Higher off is 3,600. And total of relevant earnings. Total of relevant earnings. We have three types of relevant earnings. Relevant earning means three incomes: employment income, trading income, and income from furnished holiday letting. In this question, we have only trading income 7,000. So if I say higher of 3,600 and 7,000, so obviously it is 7. When I say lower of gross PPC 15,000 and 7, so it's going to be 7. So in this question, obviously, uh, basic and higher rate band will increase by 7,000. Okay. Question number 16. I want every one of you, dear students, pause the video, try to attempt question number 16, and then you can obviously always unpause the video. But first pause, then solve the entire question, then simply unpause the video. Okay. So I hope you have tried this question. Mr. Z has a property income 46,000. He's having property income 46,000. Employment income 13,000. He made a contribution of 16 in personal pension plan. Again, nothing is mentioned. It is net. We have to gross it up by multiplying with 100 divided by 80. And his employer also contributed in occupational pension plan 9,000. When your employer is contributing for you in either an occupational pension plan or in BBC plan or even in both, it is exempt benefit for employee. He has unused, previously he has unused limit of 15,000. Okay. Property income is non-saving income. Employment income is non-saving income. So 46 and 13. 46 and 13. Mm, that is property income. Employment income. 46,000 plus 13 gives me 59,000. Let's deduct personal allowance. 12570. It is 46,430. Let's calculate income tax. So before calculating income tax, we need to find out that basic rate band will increase by what amount. Working one, band will increase with lower of gross PPC. 16,000 is net. If I make it gross, 100 upon 80, it becomes, I think, 18750. Let me use my calculator. Oh no, it becomes 20,000. It becomes 20,000. So lower of gross PPC and then higher of 3,600 and total of relevant earnings. In relevant earnings, we three earnings they come in relevant. One is employment income, second trading income, third is income from furnished holiday letting. In this question, we have only employment income of 13,000. So higher of is 13 now. Lower of 20 and 13 is 13, which means that basic rate band will increase by 13,000. So the limit is 37,700. It will increase by 13,000, which means it becomes what? 50,700. So we have taxable income 46,430. So by having limit of 50,700, we can say entire 46,430 actually falls in basic rate band. So your income tax liability is 9,286. Your income tax liability is 9,286. That's simply great. I strongly believe you had the same answer. Okay, dear student, now let's discuss another very, very important concept. What is that? Actually, we all know one thing that annual allowance limit is 40,000, okay, for pension. But if someone is a really wealthy individual, so to be very honest, then what happens? For wealthy individuals, this annual allowance limit of 40,000 gets reduced as well. Like we have seen in personal allowance, for wealthy individuals, personal allowance also reduces, and even we have seen personal allowance becomes zero if someone is having adjusted net income 1,25,140 or even more. When it comes to annual allowance of 40,000 for pension, for wealthy individuals, this 40,000 limit also reduces, but this limit cannot be zero. The minimum it can be 4,000, but it cannot go below 4,000 annual allowance limit. Now the question is, when does annual allowance limit reduce? What are the conditions? When two conditions are met, then annual allowance limit starts reducing. The one condition number one is threshold income must be more than 200,000. Threshold income must be more than 200,000. How do we calculate threshold income? Net income less individual gross PPC. From the net income, we just deduct individual gross PPC. In fact, you can say this threshold income is actually adjusted net income, ANI. If threshold income is more than 200,000 and second is adjusted income, this one must be more than 240. If adjusted income is more than 240, threshold income is more than 200,000, only then annual allowance limit starts reducing. Let me first explain how do we calculate adjusted income. Threshold income, I told you it is simply ANI, adjusted net income, because from net income you need to deduct individual gross PPC. Let us discuss the format of adjusted income, because I'm saying two conditions must be met at a time. One is threshold income must be more than 200,000 and second is adjusted income must be more than 240. So let me discuss how do we calculate adjusted income. You have to take first net income, and then simply add employees contribution in PPC, in OPPC. Simply you need to add employees contribution in OPPC, occupational pension plan, if he has contributed. Add employer's contribution in occupational pension plan. Add employer's contribution in PPC also. When your employer is contributing for you in personal pension plan, we never gross that amount. So in net income, maximum three things will be added to calculate adjusted income. Number one is employees contribution in OPPC, occupational pension plan. Number two is employer's contribution in OPPC. If your employer is contributing for you in occupational pension plan, I'm going to add that. Third, if employer is contributing for the employee in personal pension plan, it will also be added. So then you will get adjusted income. This is how you get adjusted income. So threshold income must be more than 200,000 and adjusted income must be more than 240. Both the condition must be met. If any one of the condition is met, then annual allowance limit does not reduce. Annual allowance limit for the pension 40,000 only reduces when both the conditions are met. Condition 1 is threshold must be more than 200,000 and adjusted income must be more than 240. How it reduces? For example, let's say threshold income is 210 and adjusted income is, let's say, 300,000. So requirement is calculate annual allowance limit. We need to calculate annual allowance limit. How do we calculate? Look at this. Just write annual allowance, obviously 40,000 less adjusted income is 300,000 minus 240 into 50%. It is 30,000 if I'm not wrong. Then you will be getting annual allowance 10,000, which means in the current tax year You will not be having annual allowance limit of 40,000. Instead of 40, you will be having annual allowance limit of only 10,000. Okay, let's say this is case A. In case B, I'm assuming adjusted income is 400,000. Adjusted income is 400,000. Let's say threshold income is 2,10,000, but in part B, I'm assuming adjusted income is 400,000. And the requirement is same, calculate annual allowance limit. Now check this. Annual allowance is 40,000, less the reduction. This time I have 400,000 minus 240 into 50%. Obviously, from 400,000, if I deduct 240, I will get 160. If I take 50% of that 160, it becomes 80. But I'm not deducting 80. I'm deducting 36,000. And there's a static also. So annual allowance is going to be 4,000. What do you mean by this static? This static means maximum annual allowance limit can reduce to 4,000. It cannot become actually zero. In personal allowance, we have seen personal allowance can become zero, but annual allowance limit cannot be zero. Minimum annual allowance limit is going to be 4,000, which means that any individual, any individual who is having adjusted income, any individual who is having adjusted income greater than equal to 310 or 312, obviously threshold income more than 2 lakh, threshold income obviously must be more than 2 lakh. Any individual who is having adjusted income 312 or more, that individual gets annual allowance 4,000. Any individual who is having adjusted income 3,12,000 or more will get annual allowance 4,000, because from 3,12,000 if you deduct 240 you will get 72,000. If you take 50% of 72,000 it becomes 36. Annual allowance limit normally it is 40,000. From 40 if you deduct 36, obviously you will get 4,000. Let me repeat. From 312, if you deduct 240, the difference is 72,000. If you take 50% of that 72,000, obviously it comes 36. And from 40, if I deduct 36, I'll get 4,000. So simply whoever is having adjusted income 3,12,000 or more, that individual gets annual allowance 4,000, because annual allowance cannot go to zero. So now I strongly believe you have a really good idea of this annual allowance when it starts reducing. So it is written also, note if individuals adjusted income is 312 or even more, then annual allowance limit is 4,000. So dear student, now I strongly believe you have a really good idea about this annual allowance restriction. In the next class, we'll be discussing a little bit more on this annual allowance, little bit, not more than that. And after that, we'll start NIC, National Insurance Contribution, and we'll be discussing one more concept, that is when an individual starts getting pension income in UK. After discussing NIC and the pension income extraction, we will go to employment income. So simply thank you very much watching this lecture, and let me tell you a reminder. please you need to maintain a proper register, because if you're not maintaining a proper register, then obviously it's not beneficial. Just watching videos will not help you. You have to maintain a proper register. Okay, and very soon we'll start solving. Basically, when I'm going to come on kit questions, so I'll be using, most of the time I'll be solving question on Excel, and obviously number of questions we are going to solve on, not number of, but some of the question definitely we are going to solve on CB platform as well, so that you should be having a really good idea about the CB platform, how do we solve question over there. So thank you very much for watching this lecture. Have a nice day.